Welcome to the secret world of finance. Today, we're going to explore a concept, one that Albert Einstein supposedly called the eighth wonder of the world. Our goal here, well, it's to sort of unpack its power, look at some surprising sides to it, and show you how this mathematical thing can turn even, modest savings into really extraordinary wealth. Think of this as your shortcut, maybe, to understanding the most powerful wealth building force out there for ordinary people. We'll try to pack it with practical insights and real world examples.
That's right. And, whether Einstein actually said it, the quote being, he who understands it earns it, he who doesn't pays it. Well, the feeling behind it, that definitely captures a basic truth about building wealth, about financial success. We are talking, of course, about compound interest.
Compound interest.
And at its core, it's pretty simple. It's the interest you earn on your original money, your principal, and on all the interest you've already piled up. It's really different from simple interest. Simple interest only ever calculates on that first amount you put in.
Right, just the initial bit.
Exactly.
Yeah.
But compounding lets your money grow exponentially. It creates what Warren Buffett famously called the snowball effect. It starts small, seems slow, but then it just accelerates faster and faster, like a snowball rolling downhill, getting bigger and picking up more snow.
The snowball effect. I like that analogy. It makes compounding sound almost, well, easy, effortless even. But maybe it also shines a light on a hidden challenge, which is our own thinking, our psychology. And that makes me think of this story about an elephant. You know the one, these huge, incredibly strong animals, they could pull down a tree, right? But you often see them tied up with just a thin chain, a small rope sometimes.
Yeah, I've heard that one.
And the reason is, when they were babies, small and weak, they were tied with that same chain. And they learned back then, I can't break this. So even when they're fully grown, massive and powerful, they just believe they still can't break it. They accept the limitation. They don't even try. Do you see that kind of, I don't know, psychological chain holding people back when they think about building wealth? Like, many just sort of accept they can't really be financially free.
Oh, absolutely. That elephant story is a perfect metaphor for those invisible chains that hold people back financially. And when we dig into how compound interest actually works, the power of time just jumps out. It's undeniable. Sure, there's a mathematical formula for it. You can write it down.
Right.
But what's really critical to get is that the time variable in there, it isn't just added in. It's an exponent. That means if you double the time you're invested, you don't just double your return. It can square it or cube it. It grows exponentially.
Yeah.
The effect of time literally compounds on itself.
Wow. Okay, that really hammers the point home, an exponent. So let's try and make that exponential growth a bit more solid, maybe a real world kind of illustration. Okay, imagine you invest, let's say, $10,000, and you get an 8% annual interest rate. Pretty standard long-term average for stocks, roughly. So after the first year, simple enough, you'd have $10,800, 10,000 plus $800 interest.
Right.
But here's where it gets interesting, yeah? In the second year, you earn that 8%, not just on your original 10 grand.
No, you earn it on the whole $10,800.
Exactly. And that pattern just keeps repeating. Each year's interest gets calculated on a bigger and bigger base amount. So yeah, it feels slow at first. But after 10 years, that initial $10,000, it becomes $21,589, more than double. But then stretch that out to 30 years, and it just explodes. It hits $100,627. The pickup in speed is amazing.
It really is. And, to help you quickly get a feel for how fast that growth can happen, there's a great little mental shortcut. It's called the Rule of 72.
Ah, the Rule of 72. Heard of it.
Yeah, it's super useful. You just divide the number 72 by your annual interest rate, whatever percentage you expect to earn. And that tells you roughly how many years it'll take for your money to double.
Okay, so example.
Sure. Let's say you're getting a 6% annual return. You divide 72 by 6. That gives you 12. So about 12 years to double your money. If you're getting 8%, like in your example, 72 divided by 8 is 9. So doubles in 9 years. If you manage to get 12%, well, 72 divided by 12 is 6. Your money doubles in just 6 years.
That's quite a difference.
It is. What's really fascinating there is how, seemingly small differences in the interest rate can have these massive impacts over a long time. The Rule of 72, it's not just a math trick. It's a really stark reminder of how quickly time multiplies money. It shows you that hidden speed, the velocity of your savings.
Okay, so the rate matters a lot, and time is obviously huge. But I think there's another factor too, right? Something about how often the interest gets calculated.
Yes, exactly. That's called the compounding frequency. How often is that interest calculated and actually added back into your account balance? It could be annual, just once a year, or semi-annually, twice a year, quarterly, monthly. even daily in some
And
cases.
does that make a big difference? Daily versus annual?
Well, the differences might seem tiny at first, day to day, or even year to year. But remember, we're talking about compounding. Those small differences also compound over time. And yes, they can make a truly significant impact in the long run. Let's take that $10,000 at 8%. But let's look over 20 years this time. With annual compounding, just once a year, it grows to $46,610.
Okay.
But if it compounded daily, that same $10,000 at 8% for 20 years would reach $49,522.
Well, wait, that's nearly $3,000 more.
Almost 3 grand more,
Yeah.
just from the frequency changing from once a year to once a day. It adds up.
That's pretty powerful. So it seems almost simple then. Invest early, stay invested, let it compound, maybe look for slightly more frequent compounding if you can. Why then, I mean, despite all this clear evidence, do so many people seem to struggle with actually doing it, putting it into practice?
That's a great question. And perhaps nothing shows the power and the importance of acting better than the advantage of starting early. Let's picture two people, two investors, say, Sarah and Mike. Sarah starts investing $500 every month when she's 20 years old. Mike, he starts later. He waits until he's 30, but he also invests $500 a month. Now, let's say both of them invest consistently until they turn 65, and both earn an average 8% annual return.
Okay, so same amount per month, same return. Just a 10-year difference in starting.
Exactly. Sarah invests for 45 years in total. She puts in $270,000 of her own money over that time, 500 by 12 months by 45 years, her final pot. At age 65, it's an incredible $2,637,270.
Wow, over 2.5 million.
Yeah. Now, Mike, he invested for 35 years, right? From 30 to 65. His total contribution was $210,000, 500 by 12 by 35 years. A bit less than Sarah's total input. But his final amount, it's $11,146,941.
Still over a million, which is great, but gosh, that's way less than Sarah.
Way less. It's almost $1.5 million less. Mike didn't just earn less. You could almost say he missed out on that $1.5 million of potential wealth, purely because Sarah's money had an extra decade, just 10 years, for that compounding effect to really get going and work its magic.
So it's not just about earning more interest, it's like avoiding a massive loss from delaying.
That's a great way to put it. It's the colossal opportunity cost of waiting. And it really shows the huge difference between compound interest and simple interest, what happens when your earnings start earning too.
And I guess one of maybe the most famous real-world examples of this dedication to compounding is Warren Buffett, right? Often called the greatest investor ever. He's built this immense fortune almost entirely through harnessing this power, isn't he? I remember reading about his investment in Coca-Cola. That was back in, 1988. He put in about $1.3 billion, I think, and got around 6.2% of the company.
It's right, a classic Buffett move. Find a great company, invest significantly, and then wait. Let compounding do the heavy lifting. And, to make it even more relatable for you listening, if you had invested just $1,000 in Coca-Cola stock back when Buffett first started buying his shares in '88, and you just held on to it, reinvesting all the dividends along the way, that $1,000 would be worth over $36,000 today.
36,000 from 1,000.
Yep, that's a return of over 3,500% just from hold and letting it compound. But what's truly mind-blowing about Buffett's own story, despite his investing genius, is that something like 99% of his personal net worth was accumulated after his 50th birthday.
99% after 50. Seriously.
Seriously.
Yeah.
He just perfectly underlines that time and the patience to let time work. Those are the ultimate ingredients for building really significant wealth through compounding.
Patience is key. But you mentioned earlier Einstein's quote, the second part. He who doesn't understand it pays it. So compounding isn't always good.
Absolutely not. It's a double-edged sword. While it's this incredibly powerful ally for building wealth when it's working for you, it can be absolutely devastating when it works against you. Think about debt.
Right. Credit cards.
Exactly. Credit card debt, high-interest loans. If you owe, say, $10,000 on a credit card with an 18% annual interest rate, which is pretty common, and you only make the minimum payments each month, that debt can balloon incredibly quickly due to compound interest working in the lender's favor. That interest gets added to the balance, and then you pay interest on the interest. It can trap you. That's precisely the scenario where he who doesn't understand it pays it.
That is a critical point. So the key is really making sure this force is pushing you forward, not pulling you back, which sounds like pay off high-interest debt fast, invest in things that give you compound returns, start as early as you possibly can, and be consistent. Keep investing regularly. But, okay, if those actions are so crucial, what is the single biggest psychological hurdle you see? What stops people from just doing it consistently?
That is a fantastic question. And yeah, it brings us right back to human psychology, doesn't it? Despite its, undeniable mathematical power, compound interest runs into some major behavioral roadblocks inside our own heads. Things like present bias. That's where we just naturally overvalue getting something good right now compared to a much bigger benefit way off in the future. It makes saving for retirement feel hard.
Yeah, the immediate gratification thing.
Well, exactly. Then there's loss aversion. Psychologically, the pain of losing money feels way stronger than the pleasure of gaining the same amount. That fear can stop people from investing in things like stocks, which have higher growth potential long-term, but also fluctuate more short-term. They stick with safer things that don't grow as much.
So fear holds them back from compounding.
It often does. And then there's overconfidence, believing you can time the market or pick the next hot stock.
Yeah.
It leads to too much trading. And all that chopping and changing just eats away at returns through fees, taxes, and missing out on the best days in the market. It interrupts the compounding. And finally, just plain old impatience. People want results now. They might abandon a perfectly good long-term strategy right before the compounding really starts to accelerate, in those later years. It's like, it's a constant battle against our own natural wiring.
And I suppose those behavioral tendencies lead directly to common mistakes that just sabotage the whole process, right? Like you said, starting too late is a big one. Or maybe investing too little, like putting in amounts that are too small to really move the needle significantly over time, withdrawing money early from retirement accounts, maybe?
Definitely. Early withdrawals kill compounding and often come with penalties. Another big one is not reinvesting dividends or interest. Some people get that income from their investments and just spend it.
Instead of putting it back to work.
Right. You need to put it back in to buy more shares or units so it starts compounding too. That's a huge accelerator. Chasing performance is another classic mistake. Jumping in and out of different funds based on what did well last year. That rarely works long term. And finally, something often overlooked. Ignoring fees. High investment fees might seem small, like 1% or 2% a year, but over decades, that percentage taken out every year dramatically reduces your final amount. It's like tiny termites constantly eating away at the foundation of your wealth.
Termites, yeah, it's a good visual, siphoning off growth potential.
Exactly. Thankfully, though, modern technology actually makes it easier than ever before to harness compound interest and maybe bypass some of these issues. You have robo-advisors now that can automate the investing process, handle the asset allocation, automatically reinvest dividends for you.
Takes the emotion out of it, maybe?
It can help, yeah.
Yeah.
And there are tons of compound interest calculators online. They let you plug in numbers and visually see how your money could potentially grow over time. That can be really motivating. Plus, apps that allow automatic investing. You set up a regular transfer from your bank account, say monthly or weekly, and it just happens. You don't have to think about it or decide each time.
Removes the friction, the decision fatigue.
Precisely. These tools can really help overcome some of those psychological hurdles we talked about.
Okay. So when you step back and look at it all, compound interest really does seem to earn that title, eighth wonder of the world. It's not like the ancient wonders, built by people out of stone. This is different. It's like a quiet, tireless mathematical force that just works away in the background, potentially for decades, building wealth for you.
Beautifully put. And to make sure that eighth wonder is working for you, let's maybe summarize some practical steps. Things listeners can focus on based on everything we've discussed. First, and probably most important, start immediately, or as soon as humanly possible. The earlier you begin, the more time you give that compounding magic to work.
Time is the most valuable ingredient.
Absolutely. Second, automate your investments. Set up those regular automatic transfers. It ensures consistency and takes the willpower out of it. Third, maximize your use of tax-advantaged accounts. Things like 401ks here in the U.S., or IRAs, Roth IRAs, pensions, or similar accounts elsewhere. These let your money compound without taxes dragging it down each year, meaning more of your money stays invested and working for you.
Tax efficiency boosts the compounding. Makes sense.
Fourth, reinvest all your dividends and interest. Don't take the income out to spend. Put it straight back in to buy more investments. Let the snowball grow faster. Fifth, stay invested. This means resisting the urge to panic sell when markets dip or to pour money out early for non-emergencies. Think long-term.
Right out the bumps.
Exactly.
Yeah.
Sixth, focus on keeping fees low. Compare fund expenses. Choose low-cost index funds or ETFs where appropriate. Remember, those termites, keep them away. And finally, number 7, diversify appropriately. Don't put all your eggs in one basket. Spreading your money across different types of assets helps manage risk while still allowing for good growth potential.
Start now, automate, use tax shelters, reinvest, stay put, watch fees, and diversify. Sounds like a solid plan.
It's the core of harnessing compound interest effectively.
And just to leave you with a final thought, remember that Warren Buffett stat. 99% of his wealth came after age 50. Or, if you look it up, there's this incredible story about Benjamin Franklin. He left a relatively small amount of money to Boston and Philadelphia in his will back in 1790. With instructions for it to be invested and compounded for 200 years, the amounts grew into huge fortunes for public works in those cities.
A two-century compounding experiment.
Right. The lesson from both Buffett and Franklin seems crystal clear for you, the listener. The real, mind-blowing magic of compounding. It happens in the later years, after decades. So you need to trust the process. Be consistent, be patient, and just let this amazing mathematical force, this eighth wonder, work tirelessly for you over the long haul. Thank you for listening. See you again in the next episode.